Welcome back to Metal Market News. I'm Professor Harry, and today we're diving into one of the most misunderstood and potentially explosive setups in the precious metals market, because what we're seeing right now is not just low prices or weak sentiment, it's something far deeper, a structural disconnect between paper markets and physical reality that very few investors fully appreciate. As an independent analyst, I want to make this very clear from the beginning: this is not a normal market environment. When you have historically low speculative interest, combined with tightening physical supply and rising systemic stress in the global financial system, you are looking at conditions that have historically preceded major repricing events. And in this breakdown, I'm going to walk you through not only what's happening, but why it matters, how it compares to past cycles, and where I personally agree and disagree with the prevailing narrative, because this is where real insight begins to separate from noise. What stands out immediately is the collapse in speculative participation, with open interest in silver at multi-decade lows and gold seeing levels not witnessed since around 2014 or 2015, and from a traditional market perspective, this would typically be interpreted as weakness or lack of interest, but I would argue that this interpretation is incomplete. Low speculative activity does not necessarily mean a weak market. It often means that the market is in a phase of accumulation by stronger hands while weaker participants have already exited. When I compare this to historical patterns, particularly periods before major bull runs, we often see a similar absence of speculative enthusiasm, because the crowd tends to arrive late, not early. However, I also agree with the caution that such conditions can leave the market vulnerable in the short term, because with fewer participants, it becomes easier for prices to be pushed in either direction without significant resistance. This creates an environment where short-term downside moves can occur even when long-term fundamentals are strengthening. Now when we bring in the comparison to the 2008 financial crisis, this is where the analysis becomes particularly important. The idea that gold initially sold off sharply before entering a massive bull run is not just an anecdote, it is a reflection of how markets behave under stress. In times of crisis, investors often prioritize liquidity over logic, selling assets that can be easily converted into cash, even if those assets are fundamentally sound. This is something I strongly agree with, and it highlights a key flaw in modern financial thinking, which tends to view cash as the ultimate safe haven. From my perspective, this is a short-term reaction rather than a long-term solution, because cash itself is subject to the same systemic risks that drive demand for gold in the first place. The comparison also reinforces the idea that initial price declines should not be mistaken for fundamental weakness, but rather as part of a broader adjustment process. The critique of Keynesian economic thinking is another important element here, and while I believe it is somewhat simplified, there is truth in the argument that modern financial systems often underestimate the role of gold as a monetary asset. Many institutional investors are trained to view gold as a non-productive asset, something that does not generate yield and therefore does not fit neatly into traditional portfolio models. As a result, their instinct during periods of stress is to reduce exposure to gold and increase cash holdings. However, when I compare this behavior with global capital flows, particularly in regions outside the Western financial system, a very different picture emerges. In the Middle East, for example, sovereign entities are far more likely to liquidate dollar-based assets than gold, which suggests a fundamentally different understanding of what constitutes real wealth. This divergence becomes even more pronounced when we look at Asia, particularly China, where the demand for physical gold is not just strong, it is accelerating under structural constraints such as capital controls and declining deposit rates. The introduction of rationing systems and even lottery mechanisms for accessing gold is not something you see in a normal market, it is a clear signal of supply stress. From my analytical perspective, this is one of the most important indicators currently available, because it reflects real-world demand rather than speculative positioning. When I compare this with the relatively weak participation in Western markets, it becomes evident that the center of gravity in the gold market is shifting, and that shift is being driven by fundamental economic conditions rather than short-term sentiment. Now when we turn our attention back to silver, the situation becomes even more extreme. The combination of low open interest and signs of physical tightness, including backwardation, suggests that the paper market is no longer accurately reflecting underlying supply and demand conditions. Backwardation, particularly in a market like silver, is a rare and significant signal, indicating that immediate delivery is valued more highly than future supply. In my view, this is not something that should be ignored or dismissed, because it points to a structural imbalance that cannot be sustained indefinitely. However, I would also caution that timing the resolution of such imbalances is extremely difficult, because paper markets can remain disconnected from physical realities for longer than most investors expect. The discussion around potential downside scenarios, including the possibility of further price declines driven by technical patterns or positioning, is also worth considering. While I agree that such moves are possible, I do not see them as fundamentally important in the broader context. From my perspective, focusing too heavily on short-term price targets can distract from the larger trend, which is the gradual tightening of supply and the increasing strain on the global financial system. The idea that investors should not wait for marginally lower prices but instead focus on securing exposure aligns with a long-term investment mindset, although I would add that this approach requires discipline and a clear understanding of risk tolerance. When we expand the analysis to include the broader financial system, particularly the rise in bond yields and the concept of a sovereign debt trap, the implications become even more significant. Rising yields indicate increasing stress within the system, as governments face higher borrowing costs and reduced fiscal flexibility. From my perspective, this is one of the most critical macroeconomic developments currently unfolding, because it directly impacts the stability of fiat currencies. When I compare this with historical precedents, it becomes clear that such conditions often lead to a loss of confidence in traditional financial assets, which in turn drives demand for tangible stores of value such as gold and silver. Finally, when we bring all of these elements together, what we see is a market that appears weak on the surface but is actually building pressure beneath it. The lack of speculative interest, the divergence between paper and physical markets, the shifting dynamics of global demand, and the growing instability in the financial system all point toward a potential inflection point. My own view is that while short-term volatility and even further downside cannot be ruled out, the long-term trajectory is being shaped by forces that are far more powerful than day-to-day price movements. This is not a market where the primary objective should be to maximize short-term gains, but rather to position oneself for a structural shift that could redefine how value is perceived and preserved in the global economy.